Hello, my name is Joe Hoyle, speaking to you from the University of Richmond. It's a beautiful day here today in Richmond. We've had bad weather for the last couple of days, but it's beautiful today. So I want to take a moment now to talk about Chapter 13 and liabilities. This is our first chapter on liabilities. And you will find that companies are very sensitive about the liabilities that they have to report. Liabilities tend to make a company look poorer or more risky. Therefore, they often try to avoid reporting liabilities. For that reason, a lot of generally accepted accounting principles have been developed to make sure that the proper amount of liabilities are reported when an entity does produce a balance sheet. So now you've read Chapter 13 and you've looked at liabilities. As you went through all of that material, what did you believe were the 5 most important things that we covered here in Chapter 13? As I read through Chapter 13, one of the things that really caught my attention was the topic of gift cards. Anytime that I go into a store, a grocery store, a music store, a bookstore, I will often see gift cards for sale. Therefore, how are they reported? As indicated here in this chapter, gift cards create a liability. Not that they have to be paid with cash, but that there's an obligation to perform a service or to provide a product to the holder of that card. So whenever a gift card is sold, that company has a liability. Now, it's not a payable, it's an unearned revenue. And the reason is they are going to get a revenue, but not until they provide the service or the product. So whereas a few years ago, very few companies had gift cards or gift certificates, today that has become very prevalent. So companies are having to learn how to account for gift cards. In Chapter 13, we show you how that's done. Initially recorded as an unearned revenue, a liability, and then when the earning process is substantially complete, it is switched from that unearned revenue to a revenue on the income statement. For me, when I made my list, that was number 5. As I looked through the chapter, the thing that I picked as number 4 was the method used to fix an estimation. As we have said often in this book, estimations are very common in financial statements. There's so much uncertainty, and the only way that you can deal with that uncertainty is to make estimations. However, those estimations often prove to be incorrect. Sometimes by a small amount, but occasionally by a large amount. How do you fix those estimations when you discover that they are not correct? In Chapter 13, we point out that you fix those estimations when you come up with the correct number, and that you do not, under normal circumstances, go back to the earlier estimation and change it. You change it in the period in which you find the correct number, or at least a better number. Now, in the chapter, we talked about lawsuits, for example, and warranties and the like. Those things often turn out to be incorrect. When that happens, you adjust the income for that later period when you've discovered the problem. Since fixing estimation problems is so prevalent, I wanted you to know how that was handled, and I put that on my list as number 4. Let's move now to number 3. I felt that the characteristics of a liability were extremely important for an accounting student to understand. These are covered in more detail in upper-level accounting courses. But even here at an introductory course, I felt that you should know the 3 major characteristics of a liability: a probable future sacrifice of an asset or service, some economic benefit, and that you have a present obligation that was created by a past transaction. Whenever a company is trying to determine whether it has to report a liability or not, those three characteristics are essential. If you're working for a company and the question comes up, when do we report this as a liability? It is reported when those three characteristics, probable future sacrifice of an asset or service, a present obligation based on a past transaction, they serve as the rule to determine when liabilities should be recognized. Let's move now to number 2. When I read chapter 13, I felt that warranties was the second most important thing. There were many reasons for that. I think it's a good way to learn how accounting is recognized because it does talk about both liabilities and the matching principle. Whenever you have a warranty, you have to anticipate what's going to happen. Now, as we covered in the chapter, there are two types of warranties. There are embedded warranties that come with the product. When you buy the toaster, you get the warranty automatically. There are also extended warranties that you can buy that extend the life of that warranty. The warranties are accounted for in similar fashion, but not exactly the same. For the embedded warranty, when you make the sale, you estimate what the warranty is going to cost you, and you establish the expense and the liability right then. There's where the matching principle comes in. Because the revenue is recognized, you need to recognize the expense from that warranty at that same moment. For extended warranties, you view those as unearned revenue. Now again, that is a liability, but that's shown on the balance sheet as an unearned revenue because you've received money for the warranty. Then, as you either fix the toaster or fix the product, or as time passes, you reclassify that unearned revenue into a regular revenue account. Warranties are common. Many companies have them. The accounting is very interesting. Therefore, for me, that was number 2 in chapter 13. Let's move to number 1. I've always been fascinated by contingencies. I think the accounting for contingencies is very, very interesting. A contingency is any situation that has taken place where the outcome is uncertain. So therefore, you have to determine how to account for that uncertainty. If you're talking about a loss contingency, then the rules are fairly straightforward. At the point in time that that loss becomes probable and the amount is subject to a reasonable estimation, at that time you recognize the contingent loss. Now sometimes it's difficult to determine whether it's probable, and sometimes it's difficult to determine a reasonable estimation. But when those criteria are met, then the loss liability, the contingency, is recognized. If it's a gain contingency where you're going to make money, where you're going to get something, the rules are different. A gain contingency is not recognized until the earning process or whatever has to be done is substantially complete. Accounting is conservative. It will recognize by anticipation losses, but it cannot anticipate gains. That was the rule when I was a college student. That's still the basic underlying rule for contingencies. That, to me, in this chapter was number 1. Chapter 13 is all about liabilities. It focuses on current liabilities. We look at fairly common liabilities such as salary payable and rent payable and the like. But when it comes to accounting, the real accounting issues start coming out when we talk about liabilities such as gift cards, warranties, and then just the general topic of contingencies. Your knowledge of financial accounting is growing. Each and every chapter helps to add more knowledge and more understanding to your feeling toward financial accounting. Keep working. By the end of this course and by the end of this textbook, I want you to have a strong understanding of financial accounting.